Assalamualaikum and greetings. We are Group 3 from Group D. So today we are going to present our group project for the subject of portfolio management with the course code BWFNK3033. The topic of this group project is assembly, rebalancing and performance of a portfolio with different asset classes. These are the group members of Group 3. Group 3 consists of 8 members. In this group project presentation, we will be discussing the introduction, economic analysis, industry or sector analysis, fundamental or stock analysis, analysis and discussion on portfolio performance, and lastly, the conclusion. First, we will go to the introduction part. The background of this group project: portfolio management is a process of deciding and managing a combination of investment assets that fit an investor's long-term goals, as well as risk tolerance that balances unrealized risk with expected return to achieve the best outcome. In this group project, we will be studying the best allocation of assets, identifying the asset classes and sector of consideration, and the periodic rebalance of assets over time. About this group project, we will demonstrate the grouping of a diversified portfolio of companies with specific sectors of consideration, such as Hong Leong Bank Berhad as financial services, Press Metal Aluminium Holdings Berhad as industrial products and services, YTL Power International Berhad as energy services, Westports Holdings Berhad as transportation and logistics services, and Apex Healthcare Berhad as pharmaceutical services. The objectives of this group project is to measure and assess the returns of the investment portfolio and compare it to relevant benchmarks, to measure how well investment decisions deliver on financial goals to the benefit of the investors, to identify assets delivering unsatisfactory rates of return for correctional action, and inform rebalancing and replacement strategy, to observe risk management through diversification and ongoing performance monitoring, and lastly, to continually reinforce accountability and demonstrate the overall success of the investment strategy. Now, we will look at the definition of terms. The assembling of stocks entails the planned articulation of a number of investments like stocks, bonds and commodities into a single portfolio, conforming to an investor's financial goals and risk profile. This involves both asset allocation across asset classes such as stocks and bonds, and diversification, which is across non-correlated industries, to create an optimal risk and return proposition. Rebalancing is the strategic process used to reduce variation in a portfolio's asset allocation by returning to the desired target weights once the allocation has drifted due to market factors. Rebalancing involves selling high-performing assets such as streaming back equities after a market rally, and buying low-performing and or underweighting assets such as adding fixed income if the equity allocation has exceeded the target level to keep the risk-return profile while desired. And rebalancing also can include the standard period reviews of variation thresholds. While portfolio performance is the assessment of how well the investments have performed using the quantitative analysis of return, risk and efficiency metrics. Performance metrics include absolute returns that are relative to the original investment, factors against an index or benchmarks such as an S&P 500 for a US stock portfolio, and ratio-based metrics such as risk-adjusted returns, measuring excess return against volatility in ratios such as Sharpe ratio. Now, we will discuss for the second part, which is economic analysis. The global economic environment in 2025 shows signs of slowing growth, with projected GDP expansion declining to 2.9%, down from 3.3% in 2024. This trend reflects persistent trade tensions, elevated US tariffs, and weaker demand, with risk extending into 2026. In the United States, real GDP contracted by 0.5% in first quarter of 2025, driven by downturns in finance, real estate, and agriculture. Despite this, personal income grew 6.7%, supported by wage gains and investment income. The trade deficit narrowed sharply in April 2025, with exports rising 3.0% and imports declining 16.3%, reducing the monthly gap from $138.3 billion to $61.6 billion. Malaysia's economy, however, demonstrated resilience. The first quarter of 2025 GDP growth reached 4.4%, exceeding the previous year's performance, fueled by expansions in services, manufacturing, and construction. Private consumption grew 5.0%, underpinned by a strong labor market. Unemployment stood at 3.1% and stable inflation at 1.5%. Investment activity surged 9.7%, signaling confidence in government policies, particularly sustainability and focused initiatives. Trade performance remained robust, with total trade volume increasing 3.6% year-on-year. Exports rose 4.4%, led by electrical and electronic products, while imports grew 2.8%, and Malaysia recorded its 61st consecutive monthly trade surplus in May 2025, with key export markets including the US, EU, and Taiwan. Risks to the outlook include further trade policy escalation, which could exacerbate global slowdown pressures. While Malaysia maintains steady growth momentum, the broader environment remains challenged by protectionism and uneven demand.
Industry sector analysis. First, Hong Leong Bank Berhad Financial Service. Malaysia financial sector in 2025 remains stable but face global inflationary challenge. Bank Negara Malaysia adopt a cautious monetary policy. Interest rate stable resulting in moderate loan growth especially in retail and SME sector. Rise of digital banking influence consumer behavior. HLB partners with fintech and enhance in banking service to meet market trend. Strength digitalization and strong asset quality. Challenge low credit demand due to slower economic growth. Next, Press Metal Aluminium Holding Berhad Industrial Product and Service. Malaysia largest aluminium producer, influenced by global trade trend, commodity price and manufacture output. High export dependency, particularly on the Chinese market. Aluminium demand rise from EV infrastructure and renewable energy projects. Benefit from the new Industrial Master Plan 2023 industrial modernization supports. Challenge energy cost volatility and global supply chain issue. Vertical integration aids in cost control and efficient. Next, YTL Power International Berhad Energy and Utilities. Active in conventional and renewable energy, power generation and water utilities. Support Malaysia's goal of 70% renewable energy by 2050. Invest in green tech and solar energy projects. This include fuel price fluctuation and regulatory uncertainty. Growth opportunity in green infrastructure and data center development. Long-term outlook is positive due to diversification and sustainability efforts. Next, Westport Holding Berhad Transportation and Logistics. Westport is a landing port operator located in Port Klang, crucial for Malaysia's trade and logistics sector. The industry remains vital for South Asian economic connectivity, although global trade has been slow to recover post-COVID and geopolitical tension pose risk. Westport has resilience. Its strategic location and strong regional trade link help maintain stable cargo volume. Future growth is expected through the Westport 2 expansion and digital port initiative which aim to increase capacity and efficiency. Long-term prospects are supported by rising cross-border trade and e-commerce growth. Next, APEC Healthcare Berhad. APEC Healthcare represent Malaysia's growth pharmaceutical sector. Growth is driven by an engaged population, higher healthcare demand and post-pandemic health awareness. The company focuses on generic drug production, marketing and distribution, gains support from government policy promoting local pharma production and the National Health Agenda, which aim to improve medicine access. Challenge include regulator complaints and R&D expand. However, Apex benefits from strong brand recognition and broad product portfolio and international market reach position in well for future growth.
Good day, Doctor. My name is Teoh Yi Hui, matrix number 293745. Now we talk about stock analysis. First of all, we look for Hong Leong Bank Berhad. Hong Leong Bank started in 1905 and has grown into one of Malaysia's leading banks. They offer everything from everyday banking to business loan and Islamic finance. What's impressive in their strong digital banking service, keeping them competitive in today's market. They operate in several Asian countries and focus on helping community through education and environment projects. The mix of tradition and innovation makes Hong Leong Bank a reliable choice. Hong Leong Bank financial show excellent strength. Their profits have increased significantly, with net profit margin rising from 58% to 72% in just 2 years. Earning per share and return on equity are both growing, showing they use their money wisely. The stock also looks cheap compared to its earning with a low PE ratio. Of course, no investment is perfect. Hong Leong Bank has two main risks to consider. Their current ratio is low at 0.18, which means they might struggle if they need cash quickly. Also, they are not using their asset efficiently as before, with asset turnover decreasing slightly. We select Hong Leong Bank for three key reasons. Firstly, its high profitability suggests consistent return for investors. The stock current low valuation could rise as the market corrects. Third, it's a stable option compared to riskier stock, which help balance the portfolio. To sum up, Hong Leong Bank is a strong, stable bank with great profit growth and attractive price. Moving on, let's take a look at Press Metal Aluminium, Southeast Asia's biggest aluminium producer. They handle everything from smelting to extraction, supplying key industries like automotive, aerospace, and construction. They use Malaysia's cheap hydropower to keep production costs low while focusing on sustainability through recycling and carbon reduction efforts. Press Metal financials are impressive. Their net margin rose from 11% in 2023 to 14.25% in 2024, and earnings per share rise sharply from 14.75 cents to 21.43 cents. They also have strong liquidity, which current ratio is above 1.7, and have cut their debt to asset ratio nearly in half. Thus, their lower PE ratio means the stock is now more attractive price. However, their return on equity dipped slightly, showing a small drop in efficiency. Also, their asset turnover ratio fell, meaning sales are not growing as fast as their asset. We pick Press Metal for three main reasons. First, global aluminium demand is growing fast thanks to the EVs and infrastructure project. Second, the company has a strong financial position with low debt and good cash flow, reducing risk. Third, after a slight dip in 2023, their profits are bouncing back, making this a great recovery pair. Overall, Press Metal is a strong trust its market leader with solid finance, positioned to benefit from rising aluminium demand. Now, let's talk about YTL Power International Berhad, a strong player in Malaysia utility and infrastructure sector. Founded in 1993, this company is part of the well-known YTL Group. It runs power plants in Malaysia, Singapore, and Indonesia, owns the UK Wexford Water, and operates Malaysia's first 5G network through YTL communication. It's also investing in renewable energy, which is a smart move as the world shifts to a greener solution. The profit of YTL Power have increased based on net margin double from 8.17% to 15.30%, and earning per share rise from 18.23 to 41.94 cents. The company is also using its money more efficiently, with return on equity rising from 10.15% to 17.12%. Thus, it's reduced its debt, with the debt to asset ratio dropping from 0.41 to 0.35. Even with this improvement, the stock still looks cheap with low PE ratio of 0.08, suggesting it could have more room to grow. The risk of this stock is the drop in asset turnover from 0.37 to 0.33, which could mean slower revenue growth ahead. We pick YTL Power for three main reasons. First, as a utility company, it's a defensive stock, meaning it tends to hold up well even when the economy slows down. Second, its push into 5G and renewable energy gives it strong growth potential. And third, its earnings has been growing fast, making it both a value and growth opportunity. To wrap up, YTL Power offers defensive stability, exciting growth in 5G and renewable, and strong financial performance. Westport Holding Berhad, a top port operator in Malaysia since 1994, it has grown fast due to its prime spot along the busy Strait of Malacca. The company handles container cargo, liquid bulk, and even cars. Plus, it cares about the planet, using electric machine and energy-saving technology. The mix of strong operation and green efforts make Westport a smart pick for investors. The company has shown remarkable finance strength, which its net margin increased from 33.81% to 38.31%, and EPS growing from 20.5 cents to 26.3 cents. This indicates robust profitability. Additionally, the ROE has improved from 21.37% to 23.52%, highlighting efficiency use of shareholder equity. Another positive side is the company's low and falling debt levels, which have decreased from 9.24% to 4.92%. Furthermore, the declining in PE ratio from 0.19 to 0.14 suggests that the stock is becoming cheaper relative to its earnings, potentially offer a good value. While Westport has many strengths, there are also risks to consider. One of notable concerns is the decline in asset turnover, which has dropped from 0.39 to 0.3. This could indicate slower trade growth or inefficiency in asset utilization. We pick Westport for three big reasons. First, it's highly profitable with a little debt, great for steady portfolio. Second, its PE and market to book ratios are dropping, hinting it might be undervalued. Third, port are essential, no matter the economic trade keeps going. In summary, Westport Holding Berhad stand out as a strong investment candidate due to high profitability, low debt, and attractive valuation. Last but not least, Apex Healthcare Berhad. This company began its journey in 1962 as a retail pharmacy and later expanded into pharmaceutical manufacturing in 1978. Over the decades, the company has built a strong reputation for quality, supplying its product to hospital and clinic across Malaysia. As part of the IIHI Healthcare Group, Apex Healthcare is committed to innovation and customer satisfaction, positioning itself as a reliable player in the healthcare sector. Apex Healthcare has demonstrated exceptional financial performance, particularly in 2023, with earnings per share of 55.7 cents and a remarkable ROE of 43.34%. Although this metric saw a decline in 2024, the company's strong liquidity remains a key strength, with a current ratio consistently above 2.7 across all years, indicating robust short-term solvency. Furthermore, the company maintains a low debt to asset ratio of 0.01 in 2024, underscoring its financial stability. Here are some risks to consider. The company has shown signs of declining efficiency, with its asset turnover ratio dropping to 0.95 in 2024, suggesting weaker conversion of sales relative to its assets. Additionally, there is some valuation uncertainty. As the PE ratio increased to 0.3 in 2024, this indicates that investors are paying a higher price for declining earnings, which could be a concern for further growth. We select Apex Healthcare Berhad due to reasons below. First, the stock shows significantly recovery potential following its post-2024 dip, which may present an attractive entry point for investors. Second, the healthcare sector is known for its defensive nature, offering steady demand even during economic downturns. Additionally, the company exhibits low financial risk, with minimal debt and high liquidity. Investor confidence is also on the rise, as evidenced by its market-to-book ratio, which reached 2.98 in 2024.
A very good day to everyone. My name is Khian Guan, metric number 292138. Today, I would like to present about database of the selected stock or securities. First, the analysis of initial portfolio performance has been formed from January 2025 to May. There are 5 stocks in our portfolio, which are Hong Leong Bank Berhad, Press Metal Aluminium Holdings Berhad, YTL International Berhad, Westport Holdings Berhad, and Apex Healthcare Berhad. All of these stocks will be analyzed based on the benchmark KLCI stock index. So, after collecting the database of the selected stock, we will begin our initial portfolio allocation process. In the initial portfolio investment, we will invest about 500,000 and allocate the funds to a certain proportion of each specific stock based on the Excel solver result. By utilizing the asset allocation and solver function in Excel, we can diversify the risk and make appropriate investment to reduce the risk of loss in a diversified portfolio investment. So, based on the historical share price database for each asset for the trading period from January to May, Westport Holdings Berhad, Press Metal Aluminium Holdings Berhad, and Apex Healthcare Berhad, overall share price movement was flat, while YTL Power International Berhad share price fell slightly over the year. Apart from that, Hong Leong Bank Berhad and share price fell and rose significantly.
Mukhriz, and I will be explaining on the return tracking of the initial portfolio. So this portfolio is diversified across 5 local stocks, which is Hong Leong Bank, Press Metal, YTL Power, Westports, and Apex Healthcare. So the objective is to track performance against KLCI benchmark while spreading risk. So performance was mixed. Press Metal outperformed KLCI with a 3.29 annual return, which means strong demand in aluminium sector. Westports performed steadily at 18.68% return, but offered lower volatility. Hong Leong Bank and YTL Power had minor positive returns, but also moderate volatility. And Apex Healthcare underperformed with a negative 24.24 return. and highest volatility, which is 27.65. This is due to regulatory risk and supply chain issues. So next is on the portfolio versus the KLCI. KLCI returned negative 18.16% annually, indicating broad market weakness, and the overall portfolio had high volatility, which is 14.8% compared to the KLCI, 12.1%. Next, I will be explaining on the return tracking of first balancing. So there is an introduction of microtechnology, which is the following stock, and it is a strategic move to add global exposure. And a few performance highlights, which is microtechnology delivered 231.55% annual return, leading the portfolio. Apex Healthcare rebounded with 70.20% return. YTL Power performed well with 38.74 return, and Hong Leong Bank and Westports underperformed or remained flat. So the volatility increased. Overall portfolio volatility rose to 18.3% due to high volatility from Micron, which is 55.58%, and the diversification improved as Micron had low correlation to local equities. And lastly is on the secondary balancing of the return tracking. So the reallocation is optimized further. Portfolio included Hong Leong Bank, YTL Power, Westports, Apex, and retained Micron. So Micron remained dominant, returned for 412.95% annually, showing the impact of global AI chip demand. High volatility persisted at 29.05%, driven by USD and Malaysian ringgit fluctuations. Local stocks improved. So YTL Power and Westports returned 212% and 265% respectively. Apex Healthcare recovered with a 50% return, and Hong Leong Bank remained stable at 1.84%. Risk-adjusted returns are favorable. Despite high volatility, strong returns, especially from Micron, boosted the Sharpe ratio. Sector rotation reduced healthcare weight due to ongoing weaknesses. So the strategy shifted towards international tech and strong performing local sectors, which is utilities and logistics.
In this section, we analyze the portfolio's risk and return, starting with the correlation of assets, followed by covariant analysis, CAPM analysis, and fund allocation strategies. Correlations of assets during initial portfolio. So, when constructing the initial portfolio, we examine the correlations between 5 selected stocks, which is Hong Leong Bank Berhad, Press Metal Aluminium, YTL Power, Westports Holding, and Apex Healthcare, and the KLCI Market Index. The results show that all five stocks have a moderate to strong positive correlation with the KLCI, indicating that their price movements generally follow the overall market trend. Hong Leong Bank had the highest correlation at 0.7924, followed by the Press Metal, which is 0.6592, and Apex Healthcare 0.5572. The positive correlations between stock pairs suggest limited diversification in the portfolio. Correlation of assets during first rebalancing. After the first rebalancing, which included adding Micron technology, the correlation patterns evolved. Hong Leong Bank showed a moderate correlation with KLCI at 0.5929, while Micron Technology had a strong positive correlation of 0.7662, with the market suggesting that Micron's price movements are significantly influenced by market trends. Other stocks like YTL Power, Westports, and Apex Healthcare exhibited weaker correlations, where it offered more diversification benefits within the portfolio. The second rebalancing revealed an increase in the diversification. The correlation between the Hong Leong Bank and KLCI dropped significantly to 0.0092, indicating minimal market influence. Micron Technology's correlation also became negative at negative 0.0822. Negative correlations were observed between Hong Leong Bank and Westports with negative 0.3080, suggesting that some stocks move in opposite directions. This highlights an improvement in portfolio diversification. Now, we will discuss about covariance of assets. We will start with the covariance of assets during initial portfolio. Covariance measures how asset price move together. In the initial portfolio, YTL Power and Press Metal had the highest covariance values with the market, which is 0.00011714 and 0.001671, and it indicates a strong co-movement with the KLCI, Hong Leong Bank, which is 0.00097885, and Apex Healthcare with 0.001044 showed moderate covariance, while Westports Holding had the lowest point, which is 0.000851, suggesting that it was less sensitive to market fluctuations. Following the first rebalancing, the covariance values shifted. Micron Technology had the highest covariance with the market, which is 0.00022779, showing that it moved closely with the market. Westport and YTL Power had moderate covariance value, with 0.000661 and 0.000498, while Apex Healthcare and Hong Leong Bank had lower covariance values, reflecting a weaker relationship with the market index. After the second rebalancing, most stocks, including YTL Power, Westports, and Micron Technology, exhibited negative covariance with the market, which indicates that their movements diverge from the KLCI. YTL Power recorded the highest positive covariance at 0.0000589, while Hong Leong Bank had an extremely low covariance with 0.0000209, suggesting a very weak relationship with the market. And now, we will move with the CAPM analysis. We will start with the initial portfolio CAPM analysis. The capital asset pricing model, CAPM, was used to estimate the expected return based on the stock's beta, the risk-free rate, and market return. In the initial portfolio, Hong Leong Bank had a beta of 0.8489, resulting in an expected return of negative 18.86%, while Press Metal had beta with 1.4495, and YTL Power had a beta with 1.4866, which had higher betas, indicate higher market-related risk, and expected returns of negative 21.27% and negative 21.42% respectively. Westport and Apex Healthcare had lower betas and expected returns. All stocks have exhibited negative expected returns, reflecting a bearish market environment. After the second rebalancing, Hong Leong Bank had a beta of 0.067 and an expected return of negative 14.49%, reflecting a very weak relationship with the market. YTL Power and Westport had betas close to zero, which is negative 0.00028 and negative 0.00042, and expected returns of negative 14.24%. And Microtechnology, however, had a negative beta of negative 0.337, resulting in a larger negative expected return of negative 15.72%. Despite a positive KLCI return, the portfolio's negative expected returns reflected a poor correlation with market changes. Now, we will move to fund allocations. We will start with allocation of funds in initial portfolio. In the initial portfolio, 500,000 ringgit was allocated across 5 stocks. The largest portion was 175,000 ringgit went to Westport's holdings due to its stable performance. Hong Leong Bank received 100,000 ringgit, while Press Metal, YTL Power, and Apex Healthcare each received 75,000 ringgit. This allocation balanced exposure across various sectors, aiming to manage risk while targeting returns. After the first rebalancing, the portfolio value increased to 881,342 ringgit, requiring a reallocation. The largest share was 308,469 ringgit 70 cents, went to YTL Power, reflecting its improved outlook. Microtechnology received 176,268 ringgit and 40 cents, enhancing global exposure. The other stocks received 132,201 ringgit and 30 cents, each ensuring balanced sectoral diversification. In the second rebalancing, the portfolio value grew to 1,087,581 ringgit 83 cents. RM 326,274 ringgit 55 cents was allocated to Westports, while 271,895 ringgit and 46 cents was allocated to Hong Leong Bank. YTL Power, Apex Healthcare, and Microtechnology each received 163,137 ringgit and 27 cents. This reallocation aimed to align with updated market conditions and risk levels. At the finalization stage, the portfolio value reached 1,254 ringgit and 308 and 13 cents. Westport received the largest allocation of 376,292 and 44 cents, followed by Hong Leong Bank at 350,000 and 577 ringgit. YTL Power, Apex Healthcare, and Microtechnology were each allocated with 188,146 ringgit and 22 cents. These final allocations reflects a strategic balance between risk and return, positioning the portfolio to capitalize on future market trends.
For the initial profit and loss, as of the 1st of January 2025, before any rebalancing, the portfolio recorded a strong overall return of 76.27%, increasing in value from 500,000 ringgit to 881,342 ringgit. The best performer was Apex Healthcare Berhad with a remarkable return of 179.16%, contributing approximately 313,530 ringgit. This was followed by Westports Holdings Berhad with a return of 49.92%, or about 37,440 ringgit. YTL Power International Berhad came next with 23.88%, or around 17,910 ringgit. Hong Leong Bank Berhad delivered a return of 12.48%, equating to roughly 12,480 ringgit. The only stock that posted a minor loss was Press Metal Aluminium Holdings Berhad, with a very small negative return of 0.02%, equal to a loss of just 18 ringgit. For the first rebalance, profit and loss, as of the 3rd of May 2025, just before the second rebalancing, the portfolio continued to grow, increasing by 23.4% to reach a total value of approximately 1,087,581 ringgit and 85 cents. Between the 2nd of January and the 3rd of May, all 4 assets show positive holding period returns, except for Hong Leong Bank Berhad, which slightly underperformed. The strongest performer during this period was Westports Holdings Berhad, delivering a return of 57.48% and contributing to the most to the portfolio with a gain of about 75,989 ringgit and 31 cents. For the sector rebalancing of the profit and loss, by the 31st of May 2025, after reinvesting about 1,087,582 ringgit, the portfolio saw solid growth. YTL Power led with the return of 28.2%, gaining around 46,000 ringgit. Apex Healthcare followed by 26.64% or about 43,460 ringgit. Micron Technology and Westports Holdings also posted strong returns, about 21% and 20%, contributing over 45,000 and 32,000 ringgit respectively. Only Hong Leong Bank showed a small loss of around 1,370 ringgit. Overall, the portfolio earned a profit of roughly 160,726 ringgit, a return of 50.33%, with a total value rising to about 1.25 million ringgit. For the finalization profit and loss, from the 1st to the 21st of June 2025, the finalization stage showed mixed results. Using the same weight allocation as the previous rebalance, Micron Technology and Apex Healthcare underperformed with losses of around 1,555 ringgit and 6,228 ringgit respectively. Hong Leong Bank also had a small loss of about 878 ringgit. On the positive side, YTL Power gained approximately 11,232 ringgit and Westport Holdings added about 1,900 ringgit. Despite some losses, the portfolio still achieved a net profit of around 4,472 ringgit, bringing the total value to about 1.258 million ringgit, or a return of 0.36%. For the overall portfolio profit and loss, the portfolio started with 500,000 ringgit. In the first stage, it gained a strong profit of about 381,000 ringgit after the first rebalance. Profits decreased to around 206,000 ringgit, and in the second rebalance, it was about 166,000 ringgit. The final stage, being much shorter, added just 4,472 ringgit. Despite the ups and downs, the portfolio grew to about 1.258 million ringgit, a total gain of roughly 759,000 ringgit or 151.76%. For the absolute return benchmark during initial portfolio, the CAPM helps investors decide if a stock is undervalued or overvalued by comparing actual return to the expected return. If the actual return is higher than expected, the stock is considered undervalued and may be a good buy. In this case, all 5 companies, Hong Leong Bank, Metal, YTL Power, Westports, and Apex Healthcare had actual returns higher than their CAPM expected returns. For example, Hong Leong Bank had minus 18.86%, higher than the expected 12.48%. Apex Healthcare returned minus 19.08%, which was above the expected 179.16%. This suggests that all selected stocks were undervalued, indicating strong investment potential and a portfolio filled with well-performing assets. For the absolute return benchmark during the first rebalancing, since the actual returns are higher than the expected returns, all selected stocks are considered undervalued, which may signal good investment opportunities. We also added Micron Technology during the first rebalance, and it too appears undervalued. As shown in the figure, the actual returns for Hong Leong Bank, YTL Power, Westports, Apex Healthcare, and Micron Technology were all higher than what CAPM predicted. For example, Micron Technology had minus 30.33% actual return compared to an expected 26.76%. This overall suggests buy signals for investors and reflects a portfolio filled with potential strong assets. For the absolute return benchmark during second rebalancing, in conclusion, all 5 stocks are undervalued as their actual returns were higher than the expected returns based on the CAPM model. For example, YTL Power had an actual return of 28.2%, much higher than the expected minus 14.24%. Hong Leong Bank had a small negative return of minus 0.36%, but that still beats the expected minus 14.49%. Westports, Apex Healthcare, and Micron Technology also had actual returns between 20 and 26%, far above their expected negative returns. This shows that all 5 stocks are undervalued and may be strong investment opportunities. On portfolio return relative to benchmark, from January 2nd to June 24th, 2025, the portfolio generally performed better than the KLCI index. In January, the portfolio dropped by 1.69%, while the KLCI dropped only 0.25%, mainly due to weak performance from Hong Leong Bank, YTL Power, and Apex Healthcare. In February, the portfolio recovered slightly with a 0.34% gain, beating the KLCI 0.06%. This was helped by small gains across several stocks. In March, the portfolio dipped again by 0.22%, slightly worse than the KLCI, which fell by 0.2%. Losses from Apex and Hong Leong were the main cause. In April, Both the portfolio and KLCI were mostly flat. The portfolio dropped 0.09%, while the KLCI rose 0.1%. In May, after the first rebalance, the portfolio rose by 0.79%, while the KLCI fell by 0.1%, boosted by Micron Technology and YTL Power. In June, following the second rebalance, the portfolio gained 3.84%, its best result, while the KLCI rose only 0.05%. This was driven by strong returns from Micron's, Westport's, YTL Power, and Apex. Overall, the portfolio outperformed the KLCI in most months. Good stock choices and smart rebalancing, especially the addition of Micron technology, led to better results than the market. For the analysis of portfolio tracking error and information error, tracking error shows how much the portfolio's return moves away from the market. In our case, the portfolio had a high tracking error of 97.79%, meaning performance was not very consistent with the benchmark. The portfolio did beat the market several times between February and June. For example, Micron Technology went up 0.98% in February and 1.67% in June. YTL Power, Westport's, Apex, Hong Leong Bank, and Press Metal also had small gains in those months, but the information error, which shows return compared to risk, was just 0.4%, meaning the portfolio gave low extra return for the risk taken. In summary, the portfolio had some strong gains but was not consistent with when compared to the market.
Okay, hi, Assalamualaikum warahmatullahi wabarakatuh, and my name is Muhammad Anas bin Aziz with matrix number 294634. Okay, now I will talk about the assets weightage of the portfolio. Okay, based on table, we can see is display the weights assigned to the 5 selected stock in the initial portfolio, calculated using Microsoft Excel solver. The table indicates the optimal weight allocation for each company to achieve the portfolio objective. Okay, the portfolio consists of 50% investment in Hong Leong Bank Berhad, 50% in Press Metal and Aluminium Holding Berhad, 50% in YTM Power International Berhad, 55% in Westport Holding Berhad, and 20% in Epic Healthcare Berhad. Okay, the total portfolio return is negative 23.46%, reflecting significant negative return from YTL Power International Berhad, Westport Holding Berhad, and Epic Healthcare Berhad. Okay, the portfolio variant is 0.0452 with an annual standard deviation of 0.2125 and a monthly standard deviation of 0.0177, and the Sharpe ratio of negative 1.2843 further underscore the poor risk adjusted perform of the portfolio. Okay, under equal weightage assumption, the expected returns remain negative to 3.46%, with a range of potential returns between negative 3.19% and negative 8.51%. Okay, this analysis highlights the need to reconsider the inclusion of high-risk, underperforming assets like YTL Power International Berhad, which significantly drags down the portfolio overall return. By adjusting the weight allocation or excluding such assets could help mitigate risk and improve performance. Okay, now here we establish the efficiency frontier to determine the optimal portfolio allocation. Okay, the efficient frontier represents the set of all possible portfolio that offer the highest expected return for a given level of risk, or alternatively, the lowest risk for a given level of return. Okay, from figure 5.5.11, which display portfolio allocations, we can analyze the risk-return trade-off inherent in our investment options. For risk-averse investor, the optimal strategy is to select portfolios positioned at the lower end of the risk spectrum. Our analysis show that portfolio with a standard deviation of 0.1299 generates a return of negative 1.73%, representing a conservative approach that prioritizes capital preservation over growth. However, by accepting marginally higher risk, increasing the standard deviation to just 0.1315, investor can achieve a positive return of 0.24%, demonstrating how slight adjustment in risk tolerance can meaningfully impact performance. Okay, now we go to the first rebalancing. Okay, table display the optimized weight allocation for our first rebalance portfolio calculated using Microsoft Excel solver, showing a total portfolio return of 42.91%, with Hong Leong Berhad 50%, YTL Power International Berhad 35% of weighted, Westport Holding Berhad 50%, Apex Healthcare Berhad 50%, and Micron Technology incorrect 20%. Okay, the portfolio demonstrates strong performance with an annual standard deviation of 0.1998 and improved Sharpe ratio of 1.955, while the eco-weightage scenario show an expected return range between 23.58% and 55.03% with the same standard deviation. Okay, the monthly standard deviation of 0.0167 indicates stable short-term performance, and the portfolio variance of 0.0399 reflects an optimal balance between risk and return, with Micron's technology exceptional 231.55% return being the primary driver of the portfolio overall performance. Okay, now we go to the efficiency frontier diagram in figure demonstrate the risk-return trade-off for our rebalanced portfolio, showing potential returns across various risk levels. For risk-averse investor, the optimal choice would be portfolio with lower standard deviation. Okay, the data show that at a standard deviation of 0.077, the portfolio yields a return of negative 3.11%, while accepting slightly higher risk standard deviation 0.0782 result in a return of negative 7.65%. This inverse relationship between risk and return in this range suggests this portfolio may contain defensive assets that perform differently than typical market behavior. Investors should carefully analyze the entire efficiency frontier curve to identify the optimal balance point where increased risk begins to translate into positive returns. Okay, rather than simply greater losses, the graph unusual negative return percentage at lower risk level indicate this particular portfolio may require further optimization to achieve more conventional risk return characteristic. Okay, now we go to the second rebalancing. Okay, table presents the result of our second portfolio rebalancing, showing exceptional performance with a total return of 181.40% achieved through strategic allocation across 5 assets. Okay, the portfolio weights are distributed as Hong Leong Bank Berhad 25%, YTL Power International 50%, Westport Holding 30%, Apex Healthcare 50%, and Micron Technology 15%. Notably, Westport Holding and Micron Technology delivered outstanding individual returns of 265.67% and 512.95% respectively, driving the portfolio remarkable overall performance. The portfolio carries substantial risk with an annual standard deviation of 1.0368, monthly 0.0864, and variance of 1.075. But this is justified by the exceptional returns, as evident by strong Sharpe ratio of 1.7126 in an equal weight scenario. The expected return range of 141.37% to 282.74% indicates significant upside potential. Investors should be mindful of the high volatility indicated by the standard deviation exceeding 100%. This rebalancing demonstrates successful capital allocation to high performing assets while maintaining reasonable diversification across sector. Okay, here we establish the efficiency frontier to determine the optimal portfolio allocation. The efficient frontier represents the set of all possible portfolio that offer the highest expected return for a given level of risk, or alternatively the lowest risk for a given level of return. Okay, from figure which display portfolio allocation potential returns, we can analyze the risk-return trade-off inherent in our investment options. For risk-averse investor, the optimal strategy is to select portfolio position at the lower end of the risk spectrum. Okay, our analysis showed that a portfolio with a standard deviation of 0.1155 generates a return of 2.1774%, representing a balanced approach that combines reasonable returns with controlled risk. By accepting marginally higher risk, increasing the standard deviation to just 0.1174, investors can achieve an improved return of 2.2664%, demonstrating how measured adjustment in risk tolerance can enhance performance. The efficiency frontier diagram clearly illustrates that our second rebalancing has successfully created portfolio where increased risk exposure is properly compensated by higher return. Unlike previous configurations that show inverse relationship, this positive correlation confirms we have achieved proper diversification and optimal asset allocation in this rebalancing phase.
This portfolio management project successfully demonstrated the construction, rebalancing and review of a blended investment portfolio across multiple asset classes, beginning with 500,000 ringgit allocated to 5 Malaysian stocks which are Hong Leong Bank, Press Metal, YTL Power, Westports and Apex Healthcare, selected through sector analysis and fundamental evaluation. Then we later rebalanced by substituting one position with Micron Technology to increase global exposure. The portfolio achieved outstanding results, a 151.76% 8% total return, which is 758,779 ringgit 74 cents profit, with Apex Healthcare delivering 179.16% returns initially, and Micron Technology surging 412.95% post-rebalance. Active management proved critical as we consistently outperformed the KLCI benchmark, particularly during rebalancing periods. The project highlights three key lessons, which are strategic asset allocation and sectoral diversification are essential. Disciplined rebalancing manages risk while maximizing returns, and tools like fundamental analysis, CAPM return expectations, and efficient frontier analysis effectively guide decisions. These results confirm that continuous monitoring and adaptive strategies can sustain performance across changing market conditions. So that is all from us for this group project presentation, and thank you.